Hey ma, welcome to RT classes CA and CMA Guru. Good evening, one and all. Today our discussion part is regarding standard costing, the most important concept, whether if you are doing a CA Inter or CMA Inter itself. So this concept is so easy because the people not understanding the concept behind why we are using the formulas like that is the only reason you are facing complication while you are solving standard costing problem, huh? So I hope so with this particular video whoever facing problem with concerned topic overhead variances point of view, this entire concept will right now will be cleared for you, and I hope so you may be solve this particular model problems in the examination very comfortably. So before we are starting with our concerned solving of the problem, let's go with the concerned chart, Nana. What is this chart and what is this, sir? Let's see. We are doing fixed overhead variances. If you are a CMA Inter student, especially for your group 2, this is the compulsory question in the examination for 7 marks point of view. Even you can see MCQ as well as, yeah, that's the reason you can expect around minimum of 15 marks from this particular chapter when it comes to CMA Inter group 2 point of view. That's the reason please pay attention and don't skip the theory part, and don't straight away see the solving part of problematic part. So I am giving you here the clarification how you can understand why you are going for the differences between the two things whenever you are doing the variances. This entire logic I will tell you right now. So please pay attention. Don't fast forward and don't see the particular video. See entire video completely. So and after done with the entire video, please share with your concerned friends who are the needy ones who are facing especially problem with cost accounting related to standard costing. This particular video make them very comfortable, trust me, and please make this particular concern concept will be very easy. So don't feel any complications. Let's sit and relax, and I will make you so comfortable to solve standard costing problems. So first step, we are supposed to calculate standard fixed overhead rate calculation. Our first step is what, sir? SFOR. Some people, for their convenience, they maybe try to use the word SR only. But for your understanding, I am using the word standard fixed overhead rate. What is meant by SFOR means standard fixed overhead rate. Sir, how to find out this means budgeted fixed overheads divided by budgeted hours, then you are getting SFR. What is the meaning of SFR? Standard fixed overhead rate. How to calculate the budgeted fixed overheads given in the question divided by budgeted hours. If they don't give you how to find out the budgeted hours also, while I am solving the problem, I will let you know. So please focus. So once you calculated SFOR, our second step is calculation of standard hours. Sir, how to find out standard hours? The formula is budgeted hours by budgeted output into actual output. Budgeted hours by budgeted output into actual output. Then what you will calculate? Standard hours you will calculate. Sir, whether you remember it or whether you know it or not, standard hours means not standard hours, Nana. Standard hours for actual production. If you remember, if you are a CMA Inter student or whether you are a CA Inter student, while you are solving a employee costing point of view, whenever if you are doing problems under Halsey and Rowan point of view, whenever you are fixing the standard hours, you never calculate standard hours for, means the standard output. You always calculate the standard hours for standard production, actual production, always standard hours for actual production we will calculate. So standard hours here also we will calculate by using the formula budgeted hours by budgeted output into actual output. When it comes to SFOR calculation, what is the formula? Budgeted fixed overheads divided by budgeted hours. Then what we are calculating? SFOR we are calculating. Our third step is easy, just fill in the blanks. Sir, what is this fill in the blanks? See, SFOR into SH. Second one, SFOR into AH. SFOR into RBH. Then SFOR into BH. Finally, AR into AH. But this concept, revised budgeted hours, will coming into picture only if working days are different. Which working days, sir? Your budgeted working days are not equal to actual working days given in the question, then only we will get revised budgeted hours. Got it, sir? Sir, in case if you have revised budgeted hours, your third step is not fill in the blanks. Your third step is find out revised budgeted hours. Sir, how to find out revised budgeted hours? Budgeted hours divided by budgeted working days into actual working days. Then what we will get? Revised budgeted hours we will get. What is the formula, sir? Budgeted hours divided by budgeted working days into actual working days, you will get revised budgeted hours. Sir, don't confuse if working days and budgeted working days are given, actual working days are given. It doesn't mean that RBH will coming into the picture. Where only RBH will coming into the picture? Only if budgeted working days and actual working days are not same, both are not equal, then only RBH will coming into the picture. Got it, sir? So once you calculated SFOR, what is the meaning of SFOR? Standard fixed overhead rate. What is the formula for SFOR calculation? Budgeted fixed overheads divided by budgeted hours. Then you will get SFOR. Our second step is what, Nana? Standard hours calculation. How to find out the standard hours? Standard means what? Standard for actual production. What is the meaning for standard, ma? Standard means actual production here. What is the formula? Budgeted hours divided by budgeted output into actual output itself. Then in case if you have working days, whenever your actual working days are not equal to budgeted working days, then revised budgeted hours are coming into the picture. How to find out revised budgeted hours, Nana? What is the formula? Budgeted hours divided by budgeted working days into actual working days. Then you are getting RBH itself. So now you can do fill in the blanks. SFOR into SH, SFOR into AH, SFOR into RBH, SFOR into BH, AR into AH. Now see your variances. First variance is this. Now before starting for the formula, so this is what, that is what SFOR into SH, standard fixed overheads. So what about this? Observed fixed overheads. Whatever this revised budgeted fixed overheads. Whatever this budgeted fixed overheads. What about this actual fixed overheads itself? One more time. SFOR into SH, what we are calling it as standard fixed overheads. SFOR into AH, what we are calling it as actual observed. So people by saying AH they are feeling it as actual. No, that is observed fixed overheads. How much I predetermined, how much I want to recover, how much revised, how much budgeted, how much actual fixed overheads are incurred. Got it, ma? So first formula is fixed overhead cost variance. What is the formula? SFOR into SH minus AR into AH. Sir, why? This is what standard fixed overheads, predetermined fixed overheads. This is what actual fixed overheads. The difference between the fixed overheads between standard versus actual. That is the reason what we are calling it as fixed overhead cost variance. What we are calling it as fixed overhead cost variance. This is what ma fixed overheads cost variance. Okay. Then ma easy to remember this. This is what fixed overhead expenditure variance. So why expenditure variance like this means what is the formula? SFOR into BH minus AR into AH. What is the difference between your budgeted fixed overheads and what is the difference between budgeted fixed overheads and actual fixed overheads? The difference, what we are calling it as expenditure variance. How much I estimated expenditure point of view, how much actually I incurred, my budget's point of view. When it comes to sales, sorry, material and labor variance point of view, standard versus actuals will coming into the picture. Whenever it comes to overheads point of view, budget versus actuals will coming into the picture. Why? Because budget's point of view will be the useful thing when it comes to overheads, because the estimation of indirect expenses will be very difficult. That's the reason we don't go with the predeterminations. We will go with the budgets basis calculations will be more. That's the reason if you check with the problem when compared to material and labor variances, you will see standard versus actual information more. When it comes to overhead variances, you will see budget versus actuals. That's the reason budgeted fixed overheads they will give you in the question. Got it, sir? So don't confuse how much overheads I want to incur. That is I estimated. But actually how much overheads I incurred. The difference between the budget versus actual fixed overheads, we are calling it as expenditure variance. Third one, ma, efficiency variance. What is the formula, ma? SFOR into SH minus SFOR into AH. Sir, why efficiency? What is common these two point of view? SFOR is common. What is the difference? Here standard hours, here actual hours. So hours point of view difference. Whenever it comes to hours point of view difference, hours means nothing but what? Efficiency. That's the reason. What is the formula for efficiency variance? No? Fixed overhead efficiency variance equal to SFOR into SH minus SFOR into AH. What you are getting? Efficiency. What is common? Rate is common. What is the difference? Hours point of view difference. Hours is defining what? Your efficiency itself. That's the reason what we are calling it as fixed overhead efficiency variance. Third one, Nana. Fixed overhead volume variance. Here only student will confuse between volume and capacity point of view. Sir, how to remember? Simple, sir. First, let me write down the formula. SFOR into SH minus SFOR into BH. Okay, na sir? Sir, how to remember? Because majority of the students, first three formulas, they will remember very easily. Cost variance, expenditure variance, efficiency variance. They will do mistakes, capacity variance and volume variance point of view. That's the reason, learn the logic for volume variance, then automatically you can remember capacity variance formula very easily. Sir, if you observe the question, so how to find out a standard hours? What is the basis? Output is the basis. Output linking with whichever's budgeted hours. So which is taken into account? Budgeted hours taken into account. Standard hours will generated because of output point of view different. Output means volume only. Quantity, volume, output all are in the same meaning. So you are taking budgeted hours is the base and the link up between output point of view. That's the reason when it comes to volume variance, standard hours is generated the link up between budgeted hours and volume point of view. One more time, how to compute the standard hours? Budgeted hours by budgeted output into actual output. So budgeted hours is comparison between the volume point of view. That is the reason we generated standard hours. If there is no difference of output, so automatically your budgeted hours will be the actual hours if there is no volume of difference. That's the reason volume variance means the difference between standard hours versus budgeted hours because of output point of view differences. One more time, your budgeted hours is the base. Because of output point of view difference, you are getting standard hours. Correct, sir? So, what is the volume variance formula? Standard hours minus budgeted hours. If there is no output difference, standard hours and budgeted hours are same. That's the reason. Volume variance formula is what, Nana? SFOR into SH minus SFOR into BH. And the next, Nana? Capacity variance equal to SFOR into AH minus SFOR into RBH. Here little careful, Nana. If you don't have revised budgeted hours, say the situation SFOR into AH minus SFOR into BH we will take when RBH is not there in the picture. Whenever RBH will coming into the picture, capacity variance is not between absorbed versus budget. This is the difference between absorbed versus revised budget point of view. We need to do comparison. This is what capacity variance. This is what volume variance. This is what efficiency variance. This is what nothing but ideal ideal time variance. That is calendar variance. Why I will once again tell you. The formula is SFOR into RBH minus SFOR into BH. Sir, that why RBH coming into the picture? Difference between the working days. If your actual working days and budgeted working days both are same, there is no concept of revised budgeted hours. So the RBH was generated because of working days differences point of view. Working days means calendar word we can remember. That's the reason calendar variance means what is the formula? SFOR into RBH minus SFOR into BH. Revised budgeted fixed overheads minus budgeted fixed overheads. What we are calling it as calendar variance itself. Sir, one more time. First three formulas are very easy to remember, Nana. Majority of the students will do perfectly with the first three formulas. What are the first three formulas? SFOR into SH minus SFOR into AH. First one is efficiency variance. Why rate is common? What is the difference? Standard hours to actual hours. So difference of hours because a standard versus actual efficiency will differ. That's the reason we are calling it as fixed overhead efficiency variance. Second one is cost variance. How much my standard cost, how much my actual cost. So SFOR into SH minus SFOR, sorry, AR into AH. Then what you are getting? Cost variance. Third one is expenditure variance. How much is my estimation towards the fixed overheads point of view and what is my actual. That the difference between SFOR into BH, budgeted fixed overheads, minus AR into AH, what we are calling it as expenditure. These three formulas are easy to remember. Where only student confusing volume, capacity and calendar. Calendar variance also easy remember. Why you are going with calendar variance? Those two between only. Because of working days difference only, budgeted hours are converted into revised budgeted hours. If there is no working days difference, there is no concept of RBH. Correct, sir? That's the reason calendar variance was happening because of differences between working days. So RBH is generated because of working days differences. So by comparing with budgeted hours itself. That's the reason. What is the formula for calendar variance? SFOR into RBH minus SFOR into BH. Now, how to remember volume and capacity point? If you remember volume, automatically capacity variance you can do perfectly. Sir, your standard hours, how to compute the standard hours formula? Budgeted hours divided by budgeted output into actual output, then we are calculating the standard hours. If there is no output, we can't calculate the standard hours. At the same time, if you don't know budgeted hours, you can't calculate the standard hours. So budgeted output to actual output to is linking with budgeted hours. So that is the reason for the establishment of or calculation of standard hours. Is it correct, sir? So what is the formula also we mentioned? Budgeted hours by budgeted output into actual output. So volume means output. So which volume comparison? So standard hours how generated? Because of budgeted hours. That too by comparing, by linking with what? Units. That's the reason volume variance equal to SFOR into SH minus SFOR into BH. Finally, capacity variance. Your absorbed fixed overheads versus your revised budgeted fixed overheads. SFOR into AH minus SFOR into RPH. How much you want to absorb? After that, how much you revised? So your revised is when compared to your budgeted, your revised budget is more realistic, that define your capability. Sir, if you want to establish revised budget, if you want to establish in related to absorbed overheads, so if you want to do absorption recovery versus revised budgets, both defining how much you are ability, how much you are capable of handling these two things. Capability means nothing but your ability, capacity. That's why. So this is about Nana formulas point of view. By solving one problem, you will get more clarity regarding fixed overhead variances itself. So we'll take your previous examination question only, that to December 2023 attempt question. Let's see how to calculate the concern things. Let's see first they given already fixed overheads, they are giving standard actual. This is not standard this is nothing but budgeted. Standard word will be very less used when it comes to overhead variances. That should be budget. What is your budgeted fixed overheads? 30,000. What is your budgeted units produced? 1,000. What is the budgeted time per unit? 1 hour. How many working days are there? 20. Actual working days are how many? 23. So your budgeted working days are not equal to actual working days. Then which is coming into the picture? RBH will coming into the picture. Okay, sir. And actual ARAH given. Actual output is also given. Hours per unit also given. Number of working days. So they are calculating efficiency, capacity, ideal time variance, volume variance, expenditure variance, cost variance. But this is nothing but starting also I used the word ideal time. Later on I changed it into calendar. This is nothing but calendar variance. Ideal time variance means time point of view difference, na? Working days difference. Na? That's the reason ideal time. So how many days you are ideal. But the right word to use is calendar variance itself. Ideal time variance means nothing but calendar variance itself. First start with SF4. What is the formula? Budgeted fixed overheads divided by budgeted hours. This is already given in the question 30,000, but this was not given in the question. Budgeted hours equal to how many units we are budgeting? Budgeted output into per unit time. How many budgeted output? 1,000 units. Each time unit we required 1 hour. So our budgeted hours are how many? 1,000. Then what is your SF for? 30 rupees. What is the meaning of SF for? Standard fixed overhead rate. What is the meaning of SF for? Standard fixed overhead rate. Okay, sir. This is our first step. Second step is what? Standard hours calculation. What is the formula? Budgeted hours by budgeted output into actual output. How many budgeted hours are there? 1000. Now only we calculated. How much budgeted output? 1000. What is your actual output? 1200. Where they given? Already given in the question. Then what is your standard hours, ma? 1200 hours. Okay, fine. Then the third step is what, Nana? RBH calculation. Now what is the formula? Budgeted hours by budgeted working days into actual working days. Budgeted hours how many? 1000. Budgeted working days are how many? 20. Actual working days are how many? 23. Then revised budgeted hours in 1150. Sir, if you understand, previously you may be faced lot of complication if you want to solve fixed overhead variances. This is the step-by-step calculation, even marks-wise. Whenever if the concerned institute want to allocate the marks step-by-step basis also, this is very much useful to you. First SFOR you computed, second SH you computed, third RBH you computed. Why you computed RBH? Because your actual working days and budget working days both are not same. That's the reason you calculated RBH. Then the next step is fill in the blanks. Easy enough. Fourth step. What is the computation way, ma? SFOR into SH, SFOR into AH, then SFOR into RBH, then SFOR into BH, finally AR into AH. Ma, actual hours already given in the question? No, not given. So then how to find out actual hours? See sir, here I am calculating actual hours equal to, ma, how much actual output? 1200 units. Each unit how much time required? 1.1. So 1200 into 1.1, 1320 hours we completed. Let it be fourth part. Then this will be the fifth part. So now all the data available, SFOR you know, SH you know, AH you know, RBH computed. Already SFOR, BH and ARAH already given in the question. Now fill in the details. This is 30 into 1200, that is equal to 36,000. 30 into actual hours are 1320. So 1 minute. Let's do the calculations. 30 into 1320, 39,600. 30 into 1150, 30 into 1150, 34,500. Already budgeted part already given, ma, 30,000. This is 35,000 already given. If you want, you can take 30 into budgeted hours 1000. Got it, sir? Fine. Next, Nana. Start with variances, sir. Let's start, Nana. Variances itself. First, which variance, ma? Fixed overhead cost variance. Ma, whenever if you are writing, if possible, try to present this in this format. First one, you need to write here particulars, formulae, variance. What is the formula? SFOR into SH minus AR into AH. That is equal to 36,000 minus 35,000. That is equal to 1000 favorable. Yeah, ma? That is fixed overhead cost variance. Second one is what, Nana? Fixed overheads expenditure variance. What is the formula? SFOR into BH, your budgeted fixed overheads minus actual fixed overheads. The difference is how much more difference between these two. That is equal to 5000 adverse. Next, Nana. Third one, fixed overhead efficiency variance. What is the formula? SFOR into SH minus SFOR into AH. What is common? Rate is common. What is difference? Hours point of view. That's the reason what we are calling it as efficiency. What is the difference, ma? 36,000 minus 39,600. That is equal to 3,600 adverse. Next, Nana, fourth one, fixed overhead volume variance. What is the formula? SFOR into SH minus SFOR into BH. Because volume means output, budgeted hours comparing between the outputs is the reason for the computation of standard hours. That's the reason standard hours and budgeted hours link up is what output. That's the reason volume variance means SFOR into SH minus SFOR into BH. How much, Nana? 6,000 favorable. Next, sir. Fifth one. Fixed overhead capacity. SFOR into AH minus SFOR into RBH. My if RBH was not there means SFOR into AH minus SFOR into BH. Because no revised na your estimations versus absorption. This fixing part you require lot of skills and competency. That's the reason we are using the word capacity. So how much, Nana? The difference between these two, 5100 favorable. Correct, hai na? Yeah, 5100. Last one, Nana, sixth one is your ideal time variance. That is what they are using. But I will use the word calendar variance. What is the formula? SFOR into RBH minus SFOR into BH. If working days point of view, no difference means so your estimation is less, your things was, but you are working for more time. That means ideal time. But it's not right word to use. Instead of using ideal time, better to go with calendar variance. Try to remember like that. Working days point of view difference. Working days means calendar. You can remember the things easily. So, sir, how much, sir? 4,500 favorable. Sir, if you observe the chart here, this is our chart cost variance. This is expenditure. Yeah, this is nothing but your ideal time or this one. This is your capacity. This is your efficiency. This is your volume. If you understand, your volume plus expenditure equal to cost variance. Correct, sir? See this particular one. Your volume plus expenditure variance equal to cost variance. See, ma? Your volume variance plus expenditure variance equal to cost variance. 6,000 favorable plus 5,000 adverse equal to 1,000 favorable. You can do cross checking also whether you did correct or not. Same way, your volume variance is nothing but the combination of your efficiency and your capacity and your calendar. These three things if you add, you need to get your volume variance. See, ma? So 5100 favorable, 4500 favorable, 3600 adverse. If you add your efficiency, if you add your capacity, if you add your, what is that? Ideal time. Finally, what you are getting? Volume variance. If you cross check the things, you will get the answer. Correct? See, sir, your efficiency how much? 3600 adverts. Then what is your capacity? 5100 favorable. So how much you got? 1500 favorable you got. Plus calendar variance 4500. How much? 6000 favorable. What is your concern part of volume variance? 6000 favorable. Like that also you can compare. That's the reason you can draw the chart. You can see the things. So your volume plus expenditure equal to cost variance, this one, and your efficiency plus your capacity plus your calendar variance, combiningly what you will get? Volume variance itself. Like that also you can cross check the things whether well you did it correct or not. This is the way we can solve our overhead variances. And already I told you and I promised you, this particular topic is very easy to score. If you understand the logic, just follow the concern tips what I implemented here. Draw the chart and link up the things, step by step calculation, nothing. So standard costing is also a very easy chapter to score. Got it, ma? I hope so. You are very clear about this concept. So now onwards, you don't face any complication with overhead variances calculation point of view. And if you like the particular video, please share with the concerned friends. Ma, please like the concerned video. Please subscribe our RT classes CA and CMA Guru, because how many likes you will do, that many people this particular video will share, and that many our community people will be benefited from this particular thing. That is our major agenda of doing and solving your doubts and posting the videos from time to time basis according to the student request, because our channel is majorly for student purpose, to clarify their doubts from time to time wherever they are facing difficulties. Always we will come up and we took the challenges the students what they are facing, and we made the concern challenges into their opportunities, and we are doing our best for serving to the students. So please your support make us immense support, and we can do more videos, and this may be reached to so many people who are ready, who can't afford classes, who can't make much time to the revision of the concern things. They can't search for so many sources. Just they are subscribe our channel. If they go through with our videos, even before examination also, it will be very clear with them conceptual wise. And in soon I will come with even marathon videos from chapter to chapter basis itself. Yes, sir. Please subscribe our channel and please like this video and share to your friend who are facing complication with overhead variances. I hope so. Those people also will enjoy after seeing this particular video. They will be very comfortable with standard costing, especially with overhead variances itself. Thank you, ma. Have a nice day.